Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. If you're an advisor, you know just how many hats you have to wear. Sales, marketing, portfolio management, relationship building, accounting, a dozen other functions that fall on your plate, often all at the same time. That's where YCharts steps in. YCharts is a one-stop shop for all your investing research and client communication needs. With its intuitive interface, pre-built research templates, and custom reporting tools, you'll save hours of time each week and be equipped with the tools and data you need to uncover better and newer investing ideas. Click the link in the show notes to start your free YCharts trial and get 20% off your initial subscription. New customers only. Welcome back, everybody. Into summertime, we have one of our fan favorites back for at least his fourth appearance. Our guest is Rob Arnott, founder, chairman of Research Affiliates. Today's episode, Rob is going to talk about his newest article, paper, strategy. I love it. It's super cool. We're going to touch also on the state of the markets, what's going on, the economy, and lots more. Rob, welcome back to the show.
It's always a privilege. Thanks.
So I tweeted out, so followers on Twitter and elsewhere, this new article you guys published, which immediately spoke to me, called Nixed, The Upside of Getting Dumped. It has a couple rhymes with some work you've done in the past that we'll probably get into a little bit. But give us, what's the inspiration? What was the idea here? And we'll dig in.
Indexing is the gift that keeps on giving. The indexing world has a whole array of interesting peculiarities. Firstly, index funds aren't passive. They do trade. They add stocks to the index. They drop stocks from the index. And that active process has a pretty regular pattern to it. We wrote a paper, I think it was in 2018, Buy High and Sell Low with Index Funds, and came out in the Journal of Portfolio Management. And in it, we looked at stocks that are added and stocks that are dropped. Now, what makes the S&P Index Committee interested in adding a stock to the index? Typically, it will have soared. It will be popular. It will be beloved. It'll be trading at high multiples, and it will have risen sharply in the past year, and therefore will have a market capitalization large enough to be interesting to the Index Committee. What's that stock going to replace? Well, there are deletions from the index that are corporate actions, where there's a takeover or a merger or whatever. Or, as with First Republic Bank, the company ceases to exist. Those kinds of things are not discretionary deletions. But absent one of those being available, they got to kick something out. And what are they going to kick out? They're going to kick out a stock that has tumbled. Its market cap is no longer large enough to be interesting. It's trading at a deep discount to the market. It is unloved. It's believed to be facing severe headwinds, and probably is. And so what we found was that if you compare additions to deletions, the additions trade at about 4 times the valuation multiples of the deletions. That's the average. I mean, there's extreme examples that are much, much wider spread than that. When Tesla came in December of 2020, it took the place of Apartment Investment Management, which was, best of my recollection, an apartments-based REIT. Tiny market cap. Performance had been dreadful. And when they add a stock, the mere process of adding the stock pushes it up markedly. The process of dropping a stock pushes it down markedly. And the aftermath was interesting. When we wrote that paper, we found that the additions, because they've been pushed up, by the time they're added to the index, they're very fully priced, and they tend to underperform over the next year by a modest margin, 1% to 2%. The deletions are less liquid stocks, and the S&P indexation, for instance, owns 25%, give or take, of the market cap of every stock in the S&P 500. And so when a stock gets dropped, 25% of its total market cap has to be sold in a single day. So those stocks, on average, bounce back by about 20% in the next year. That seems likely to be kind of an interesting strategy. Now, the 20% is lumpy. It's chunky. When S&P has had high turnover, like the aftermath of the global financial crisis, during the run-up and crash of the dot-com bubble, turnover was high. And that's also when a large value was added by the deletions after they were deleted. So there's turnover, and it's expensive turnover. There's a 20% performance spread between additions and deletions. Well, gosh, that's got to cost the indexes some money. Multiply it by the turnover of the index, which tends to be about 4% per annum. And that works out to 4% turnover times 20% spread. You'd think 80 basis points. But no, it's not, because the deletions are, in fact, tiny. We ask the question, what if you simply are patient about it? What happens if, when S&P changes the index, you stick a Post-it note on your fridge saying, this stock's being added, this stock's being dropped, and then a year later you take that Post-it note and you do the trade. If you do the trade 1 year late, you add over 20 basis points to S&P returns per annum, compounded. Well, that's pretty cool. So we began thinking about, is this unique to the S&P? We looked at it on Russell. Very, very similar results. We looked at it on NASDAQ 100. Very similar results. We have done superficial examinations of, for example, EFA and other indexes, similar results. That's when we realized that it's not that S&P or Russell are doing anything wrong or anything dumb. It's just that by the very nature of cap-weighted indexing, you are deleting stocks that are deeply out of favor, trading at deep discounts, and all they have to do is fare a little less badly than people expect, and the price can soar. So we decided, why don't we create an index of deletions? We call it NIXT. And the paper points out that most of us at some point in our life have had the experience of being dumped. It's not fun, but you can benefit and learn from it. And likewise, when stocks get dumped, they can struggle and do very badly, or they can get their act together and perform better than expected as a business, and therefore perform much better than expected as a stock. So we tested the idea of NIXT with S&P and Russell deletions. If you do that, what you find is that over the next 5 years, those deletions on average outperform by over 5% per annum for 5 years. So do you want to buy the deletions of this year and hold it for a year and have 100% turnover in thinly traded illiquid stocks? Or do you want to buy a broader roster of stocks that have been deleted any time in the last 5 years from, let's say, S&P or Russell? We want to be very respectful of their intellectual property. And so we decided to test our own index. Let's take the 500 largest market cap stocks in the United States and the 1,000 largest market cap stocks in the United States, and let's look at how stocks that fall off of those indexes perform. Well, gosh, they did exactly the same as S&P and Russell deletions. The value added was the same. So without encroaching on their intellectual property, we created an index, NIXT, that buys stocks that have fallen out of the 500 largest market cap or out of the 1,000 largest market cap stocks, and have done so by a margin big enough that they're not likely to flip-flop back in on the very next rebalance. And that very, very simple index beats the indexes that they're dropped from by 5% per annum over the next 5 years. It also gets interesting in a number of other ways. Stocks that are dropped from the top 1,000, are they likely to be in the Russell 1000? Well, of course not. They're likely to be in the 2,000. Stocks that are dropped from the top 500 by market cap, are they likely to be in the S&P? No, they're now small enough market cap that they're likely to be out, and in fact are reasonably likely to be outside of the top 1,000. So interestingly, the sensible benchmark is Russell 2000 value. So the NIXT index is just a really interesting way of capturing small cap value And by using 5 years of deletions, you capture that full 28% outperformance. You wind up with an average of over 150 stocks. Right now it's 142, I believe. Stocks are removed after 5 years or if they re-enter the index. Now, there's a lot of flip-flops. When S&P and Russell drop a stock, about a third or a fourth of the time, it comes back into the index in subsequent years. When they add a stock, it might turn out to be the next Tesla or the next Nvidia, or it might turn out to be some fluff stock that fails to live up to expectations and falls off the index a year or two later. There's a lot of that kind of flip-flop turnover, and that's expensive. So if you take the other side of those trades, you hold the stock for 5 years or until it re-enters the top 500 or the top 1,000. In doing things in this fashion, you wind up with a broadly diversified portfolio. You wind up capturing Russell 2000 value returns plus that alpha, and it winds up being a great way to capture deep value, small cap, out of favor, unloved companies. And everybody loves an underdog. So buying a collection of 150 underdogs, it's a fun idea.
I love this strategy. And there's a lot that you mentioned that we can dig into. It also brings up some painful memories in middle school where I got dumped by Elise by a note. She gave me a note. She said I was too possessive. But I remember this to this day. So getting dumped sears in your brain.
Elise, did you say?
Elise,
She
yeah.
dumped me too.
Oh, man, something about that name. Man killer. If you look back, you've done a lot of research on market cap weighting, why it's suboptimal. And one of the cool things about this, and it's very concise, well done paper, is it's not just about the discretionary deletions. So it often surprises people. And I think a lot of investment professionals, when you tell them, well, the S&P's got a committee. This isn't just an automated system. I think most people would assume it is. But then you have the regular pure indexes out there. How much of this in your mind, if you had to kind of rank order what this is really picking up, do you think it's mostly sort of the value spread? Do you think it's the intermediate term, or I guess midterm mean reversion, that sort of 5-year period, or that the market cap is just traditionally more expensive? What is the main muscle of movement this is picking up? Or is it just the psychological, hated, discarded sort of equities?
You've given a laundry list of contributing factors, and they all matter. They're all part of it. So one thing that gets shockingly little attention is we're working on a paper called Membership Has Its Privileges. Being a member of the S&P or the Russell 1000 carries with it a premium multiple. And that premium multiple today is on the order of 40 to 50%. Well, if you have a 40% premium, that means you have lower future returns than you would otherwise. Not necessarily lower than the excluded companies, but lower than it would have been otherwise. And that relative valuation is one of the privileges of being a member. If you're added to the index, you carry a higher multiple. Another privilege is that when money pours into index funds, as it's been doing for a good third of a century and prodigiously the last 20 years, then all of the stocks that are in the index have a subtle upward performance pressure. And that's what's created this huge wedge of valuation. A quarter century ago, the valuation differential was 10%. Now it's 40%. So going from a 10% to a 40% premium, annualize that, and that turns out to be a big contributor to the returns of the indexes. And that lasts as long as the inflows continue. So membership has its privileges, but being a non-member also means that you're trading at a discounted multiple. It means that you're trading at levels that if your business exceeds relatively anemic expectations, the stocks can do very well. And so part of the effect is the effect of being kicked out, a liquidity effect that drives the price down. That portfolio of the deletions from the 500 largest market cap and deletions from the 1,000 largest market cap has something on the order of a 75% overlap with a portfolio that simply took S&P and Russell deletions. So the strategies resemble one another and their performance is just about identical. So it's a value effect. It's a small cap effect. It's an effect associated with being unloved. It's a liquidity effect. It's a long horizon mean reversion effect. Mean reversion, I think, is one of the most powerful forces at work in the capital markets and is not given nearly as much attention or credit either in the practitioner or the academic community as it should. Mean reversion happens in valuation multiples. It happens in earnings. A company with soaring earnings is going to attract competitors. And watch out, Nvidia. Others want your market share. And a lot of these things aren't adequately discounted by the market.
You've done quite a bit of work over the years on factors and styles and when they look particularly attractive or less attractive. This has to have, as you mentioned, some value rhymes to it by its nature. How does it look here in 2024? It's a leading question. I imagine it looks pretty good, but give us some feedback.
It sure does. I'm a contrarian. I love buying what's out of favor. This is the first time we've been directly involved in launching an ETF. We've had licensees embrace our ideas and launch ETFs. PowerShares, now Invesco, was one of the first. Schwab, PIMCO, ProShares, the list goes on. But this is the first where we've taken the initiative and said, we want to launch this. And we're partnering with Alpha Architect and ETF Architect. So they are launching the Nixed ETF. Ticker symbol is the same as the name of the index, NIXT. And that's an exciting decision. I had to wait 70 years to decide to launch an ETF. A lot of companies will launch an ETF when the back test or the performance of the paper portfolio is stupendous. As a contrarian, I love the fact that we're launching this when small cap is deeply out of favor, value is deeply out of favor, small cap value is doubly out of favor, and they're priced to offer much superior forward-looking returns. So we have a website, Asset Allocation Interactive, that helps people see what forward-looking returns are. The whole purpose of the website is to get people to shift their focus from past returns to future returns. That website currently forecasts for S&P and Russell a return of about 3.5% a year for the next decade. How many index fund investors will be thrilled with 3.5%? It's less than T-bills. The reason for that is that the yield is only about 1.4%. Historical growth in earnings and dividends tends to be about 2% above inflation. So if inflation is 2.5 and real growth is 2 and the yield is 1.5, well, that gets you to a 5.5% return. And that's what you would expect if today's Shiller PE ratio of 36 is still in place 10 years from now. If there's mean reversion back to historic norms, which are about 18, then you actually swing the return negative. But if you mean revert just halfway, so you go from 36 to 27, you pull the return down to the 3 range. And so our return assumption is 3-ish. Now, small cap is trading at a Shiller PE ratio not too far above historic norms because small cap is out of favor. Value is in line with historic norms. So for both of those, you're looking at capturing the yield. For small cap, it's low, but for value, it's not. For value, it's in the 2.5 range. You get the same real growth in earnings and dividends on average with a value and a small cap index as with a large cap. And then you don't get the mean reversion. So now you're up around 6%. If you take a value index, you also have the relative valuation between value and the broad market. If you look at the Fama French value factor, which is constructed using price to book value, I have big issues about using price to book. It's too simplistic. It's a 19th century concept, but let's roll with it because that's the academic norm. The Fama French growth portfolio at the top of the dot-com bubble was priced at 8 times the price to book value of the value portfolio. After the COVID value meltdown in 2020, it got to 9 times. It's tested that low twice, back to 8 times at the end of 2021, back to 9 times today. So the spread between growth and value is at very near all-time record highs. It's in its cheapest percentile ever. Now, that doesn't mean it can't go to 10 times, but it does create an asymmetric risk, and I love asymmetric risks. If it goes from 9 times to its historic norm of 4 times, that means that value more than doubles relative to growth. Again, let's assume you get half that. You're still going to have about 4% per year higher return for value than for the broad market over the course of the coming decade. So if you take that small cap return of 6 and add 4 per annum, now you're at a 10% return. And so small cap value, we're forecasting 10% per annum compounded for the coming decade. If you can beat that with a Nixed index, now you're up at 12, 14, even 15. I love introducing an idea when it is cheap, unloved, out of favor, and likely, in our view, using our models, to produce really interesting returns. So needless to say, I'm a seed investor.
We're excited to see it. Listeners, check out the ETF. You guys know Wes and friends. Wes is like a brother from another mother. He may be a horse race with you on who's been on the podcast the most, but we'll also add show note links to the Asset Allocation Interactive. I was playing around with it.
Someday have us both on. That'd be fun.
That'll be a blast for sure. Conceptually, this should apply to other countries and other indexes too. You've written a lot of papers and always have lots of new ideas, but theoretically, like you could expand this to EFA or EEM or who knows what.
Like I said, this isn't about S&P or Russell doing something dumb. It's inherent, it's structural in the nature of the way cap-weighted indexes are constructed. They're constructed using market cap as a key input into whether the stock belongs in the index or not. We also introduced a new form of cap-weighted indexing called RACWI, Research Affiliates Cap-Weighted Index, that simply changes the paradigm of why you would add a stock or delete a stock. Instead of adding a stock when its price has soared, when its market cap has soared, and therefore being a growth-tilted, momentum-chasing, popularity-weighted index, you wait until the company is in the top 500 or the top 1,000 by its economic footprint, using blended measures like sales, profits, book value, dividends. And when the company is big enough to justify being in the index, then you add it to the index and you cap weight it. And so this simply takes the RAFI concept, the fundamental index concept, and says, let's cap weight it. Let's create a better cap-weighted index. And what we find is all over the world that beats conventionally constructed cap-weighted indexes by 0.5% a year, going back over the last 30 years. We took the index live in September of 2021, and RACWI Global has beat MSCI ACWI by 2% per annum for just under 3 years with 1% tracking error. Well, 1% tracking error, indexers will say tracking error is a sign of sloppiness. No, it's a sign that your portfolio doesn't exactly match. And S&P and Russell have over 1% tracking error. Does that mean one is bad and the other's good? No, they're just different construction, and they're both widely accepted as reasonable cap-weighted indexes. Well, why not take the 500 or 1,000 largest companies and cap-weight them? You wind up with about 95% overlap between RACWI Global and MSCI ACWI. 95% overlap and 2% per annum incremental return. That means the non-overlap holdings are having a 40 percentage point difference in returns. Now, admittedly, that's an artifact of launching on the eve of a somewhat tumultuous market. So market volatility is our friend. In more normal circumstances, I'd expect it to add about 0.5%. But that's another innovation that comes off of this same body of research that all has its roots in RAFI, fundamental index, the notion that why do you want to select stocks based on their popularity and their market cap? And why do you want to weight them based on popularity? Well, if you want to track the market, you got to cap weight because the market's cap weighted. So let's take that aside and then think about how do we select stocks. You're going to add a Tesla and an Nvidia later than conventional indexes. But a frothy company that comes and goes, you don't have that flip-flop, or at least far fewer of them. A company that tanks because it's out of favor, but is still a big business, and then it regains its footing, it finds its way against those headwinds, and performs decently as a business, snaps back to market valuation multiples, and the index has to re-add it. We don't have those kinds of flip-flops. And so this is part of a whole suite of ideas that we work on and develop as better indexes. It's a lot of fun.
As we look back, there was a brief moment, 2021, 2022, where I was like, all right, this is going to be the value turn where 2 years, 5 years, 10 years of this. And it feels like it sort of happened not foreign developed relative to the US, but value in foreign developed and emerging seems to be cranking in the US. It feels like to me, but I'd love to hear your opinion. It's done well, but it's been masked a little bit by this kind of very concentrated, whatever you want to call it, Mag 7 or just very top heavy type of securities. Any thoughts, or when we look back on this in a couple of years, what we'll be saying?
Well, firstly, whoever coined the expression Magnificent Seven must not have seen the movie because 4 of the 7 are dead at the end of the movie. There's also substitution effects. I notice that these days when people talk about Magnificent Seven, they're replacing Tesla with Broadcom. So maybe it's Magnificent 6 plus 1. Anyway, this is an AI-fueled, growth-dominated bull market. The narrative is that AI will change everything. It will replace millions of white-collar jobs with computers that are smarter than the white-collar professionals. It will create millions more jobs for those who know how to use AI. It will replace countless professions, and it will leverage everything we do. So it could actually fuel a surge in GDP growth that could be quite stupendous. Like most narratives, there's a lot of truth in that. The narrative at the top of the dot-com bubble was the internet's going to change everything. The internet is going to change the way we buy and sell products. It'll change the way we get our news. It'll change the way we interact with friends, with customers. It will change everything. And it did. Why did that bubble burst? It burst because the narrative was already embraced by the market and fully reflected in share prices, such that one wit quipped that the market was not only discounting the future, but the hereafter. And I thought that was a lovely turn of phrase. But in any event, you look back at the dot-com bubble, the narrative also said this is going to happen really fast. And the narrative also said these dominant players today are going to be the dominant players in 10 years. Well, disruptors get disrupted. My favorite example is Palm. Palm was spun off in, I believe it was February of 2020 from 3Com. And the first day of trading, it went to a market cap larger than 3Com was before the spinoff, meaning the rest of 3Com had a negative value, I guess. Anyway, within days, it was worth more than General Motors. And 2 years later, BlackBerry ate their lunch. And 5 years after that, the iPhone ate BlackBerry's lunch. I gave a speech a few weeks ago, and I asked the audience, show of hands, how many people here have Palm Pilot? And obviously, people chuckled. Nobody. How many have BlackBerry? And 3 hands went up out of about 300. Disruptors get disrupted. The narrative today is AI will change everything. AI will evolve shockingly fast. There's a paper by one of the co-founders of OpenAI that says that as of last year when he wrote the paper, AI is as intelligent as a reasonably good high school student. Within a year, it'll be as good as a reasonably competent college student. Within a year after that, a reasonably competent PhD, and a year after that, it'll be smarter than any PhD on the planet. I mean, there's scary elements to that too, but that's the narrative. That narrative also makes the assumption that 20% of the US power grid will be devoted to AI by 2027. I don't think so. So narratives have the advantage of being largely true, have the disadvantage of being entirely priced into current share prices. And when elements of the narrative turn out to fall short, maybe AI will be smarter than the smartest PhD on the planet in 10 years instead of 3 years. Maybe Nvidia will be the dominant producer of super chips in 10 years, but not the only major producer. If you've got a $100 billion sales engine that's producing a $60 billion run rate profit, I mean, that's a humongous profit margin. AMD, Intel, and Taiwan Semi going to sit on their hands and say, okay, you have a moat. It's difficult to do what you do and to build the infrastructure to create what you create, so we'll let you have it. No, of course not. So you can do a simple back of the envelope, and let's say demand for super chips goes up 40% a year for the next decade. Let's say that Nvidia's market share goes from 90% to 40% over the next 10 years. It's still the biggest player. Let's assume that competition brings the price down by 2/3. Run those numbers and you find, oh gosh, Nvidia's peak profits are 2025, and they make less in 2034 than they did in 2024. That's not a forecast. I don't know enough about super chips or about the inner workings of Nvidia and its competitors to say that's a forecast. But it's an illustrative example where simple arithmetic with simple assumptions that seem pretty reasonable, pretty sensible, lead to an outcome that nobody in the marketplace would dare suggest, the notion that their profits will be lower in 10 years. And yet it's simple arithmetic.
Well, we're recording this on the day after, listeners, so end of August, where Nvidia just reported spectacular, amazing results. But you kind of get to this point where so the stock is down today, where you get to this concept of expectations, even when the news is good, getting baked in versus stock starting to fall on good news. Who knows? By the time this comes out, Nvidia may be a $5 trillion company. Who knows? But interesting to see nonetheless.
My favorite case study from the dot-com bubble isn't Cisco or Pets.com, it's Qualcomm. Qualcomm was the most up stock on the planet in 1999, up 2,700% in a single year. It came into the year 2000 at 280 times earnings. It had a moat. Qualcomm creates the plumbing for the internet. It has a moat. It's very hard to break into what they do, and what they do is essential in the fastest growing industry in the world. And there's wonderful growth as far as the eye can see. That narrative rang true at the time, enough to command 280 times earnings. Roll the clock forward to today. How's Qualcomm done as a business? Profits last year were 60 times as large as the profits in 1999. 60-fold growth. Well, if you get 60-fold growth in less than a quarter century, that must mean the stock's done pretty well. No, it's had half the return of the S&P 500. So what was wrong with that? The narrative was this was all going to happen in 10 years, not a quarter century. I'm on record suggesting that Nvidia is a bubble. Unfortunately, I'm on record from almost exactly a year ago saying that. Never short a bubble. But Nvidia is an interesting example because it's priced at 70 times earnings and 40 times trailing 12-month sales. People will say trailing numbers don't matter. This is a growth engine. Earnings will be twice as much in the coming year, and maybe they will be. But I don't have a problem with 70 times earnings. I have a problem with 40 times sales. 40 times sales is very hard to justify and presupposes a lack of competition. The notion of a 55 to 60% profit margin, net of all costs of goods and services, net of all operational overhead, net of all R&D into new product innovation, net of all taxes paid on your profits, is an astonishing profit margin. I think the Achilles heel for Nvidia is not future growth. I think the future growth is highly likely. I think it's profit margins and competition that erodes their market share even as their sales continue to grow.
Well, hey, that's free markets, creative destruction. That's the way it's supposed to be.
It really is. It really is.
One of the things we've talked on past podcasts about, Cam Harvey, obviously one of y'all's partners and great professor, the macro kind of backdrop, whether it's inverted yield curves, everyone seems to be focused, as they're apt to do, on the Fed and what the Fed's going to do and lowering interest rates. As we look out to the fall, any general thoughts, or as you're scratching your head or thinking for the rest of 2024, any thoughts on markets in general?
A few quick observations. Firstly, as I've said in the past on the show, and as you notice from my earlier comments today, I love asymmetric risks. If the market is priced to reflect a consensus view, and that consensus view almost always has merit, almost always is a reasonable scenario that could easily happen, but often there's an asymmetric risk. So take inflation. Break-even inflation in the TIPS market is 2.1% over the next 10 years. That means the market is priced to reflect an expectation that CPI will rise at 2.1% a year the next 10 years. I've tried this on a number of audiences recently. If you ask the audience, 2.1 inflation, assume there's a symmetric risk, might be 3.1 over the next decade, or it might be 1.1. Are those equally likely? And you'll find 95%, give or take, of the people say 3.1 is more likely than 1.1. I'd fall in that camp with the caveat that if the AI revolution is as big and as fast as its advocates suggest, that's a disinflationary pressure that could be bigger than people expect. But with that as a caveat, I love the asymmetry. I think the asymmetry is very definitely on the upside for inflation. If inflation exceeds expectations, if we have higher for longer, and by the way, we did a number of research papers that show that higher for longer is the norm. Transitory or last mile, or this is going to be fixed in the next year or two, is not the norm. When you get bursts of inflation above 6 and particularly above 8, it often takes quite a few years to get it fully under control. If you have inflation shocks to the upside, firstly, that's bad for growth and good for value. Secondly, that's bad for mainstream stocks and mainstream bonds and good for diversifiers, liquid alternatives. So that points in the direction of portfolios of liquid alternatives and, to the extent that you own stocks, value. Now, and to the extent you own bonds, inflation-linked bonds. So that's one actionable takeaway where there's an asymmetric risk. Another is the economy. PMI, Purchasing Managers Index, is in its bottom quartile, historical quartile. It's weak. Inventories are in their worst quartile ever. Inventories are too high. Speaking of Cam Harvey, yield curve inversion is in its worst, well into its worst decile ever, even now, even after some of that inversion has softened. But you're looking at an inversion that's third or fourth percentile of all of history. Rate of change of the cost of capital on a rolling 3-year basis, cost of capital up by an amount that's in the worst quintile ever. These are 4 measures that are wonderful predictors of economic slowdown. So, and they've been flashing amber for a while now. So what is it about the economy that allows the economy to have been so robust in the last year or two and continuing robust today? 2 factors are dominating. 1, a wealth effect from a rip-roaring bull market, and 2, consumer spending. During the pandemic, consumers started to spend like there's no tomorrow because they thought there might be no tomorrow. So why not spend it? And lo and behold, there was a tomorrow. And once you start spending more than you should, it's hard to stop. So people continue to spend, creating incremental debt, creating incremental non-performing loans. Auto loans and credit card loans are at highest non-performing levels since the global financial crisis. So the question is, will those four indicators have time to turn and become more benign before the money runs out on the spending and before the wealth effect from the bull market wraps up? And I don't know the answer on that, but I do know that risks are asymmetric. The likelihood of a robust economy going to a booming economy is less than the risk of a robust economy going to a soft economy or a recession. Our work suggests 75% likelihood of slowdown in the coming 12 months. We don't model recessions. We model, is growth going to be above or below trend? Recessions are once every 7 years, something like that. Slower than average growth is every other year. So it's more useful to forecast. And our work says 75% risk of slower growth than normal. When has it said that in the past quarter century? The aftermath of 9/11, the late 2007, early 2008, ahead of the global financial crisis, and 2019, ahead of the COVID meltdown. Now, obviously, our models didn't predict COVID, but what our models were basically saying is, if there's no COVID, you're still going to have a slowdown and maybe a recession. So we look at this and say, there's another asymmetric risk. Now, ameliorating factor, and this is a fun one. We have a paper coming out shortly, and I'm going to tip my hand to the contents of that paper. The paper is entitled, Markets Don't Care Much Who Wins the Election. In that paper, we show that contentious and close elections are preceded by the market dropping, and after the election, regardless who wins, the market comes back. Why? Because in the run-up to the election, in a contentious election, you hate the other side, you're terrified that they're going to win, and people on the other side of the political divide hate your candidate and are terrified they're going to win. So both camps go risk off as the election approaches. And one side goes risk on after the election because they're no longer worried. All you have to do is have one worried camp less worried, and you get a rebound. So it's a pretty pronounced move. It's about a 3% average drop in the weeks leading up to the election and a 4% rebound. And the rebound starts roughly a week ahead of the election. My hypothesis on that is very simple, and that's that in the days leading up to the election, the outcome starts to become a little bit more clear, and one side starts to worry a little bit less. When I say the market doesn't care much about who wins, the markets do better in a trifecta Republican win than a trifecta Democratic win. If it's not a trifecta, neither side's going to get their agenda done. They'll be stalled. If it's a trifecta, they might, and Republicans tend to be more business friendly. So that's the one area where there is a bit more of an outcome that relates to who wins. The other one that's interesting is small cap underperforms in the run-up to an election and rebounds in the aftermath of the election, regardless who wins. Why? Small cap is less familiar. It's more volatile. It's perceived as riskier. And if you're going risk off, you're more likely to want to take those chips off the table than the less risky chips. And as one side regains confidence, it's more likely to go risk on in the riskier side of the market. So this is a fun little paper that's coming out in the not too distant future.
Well, I look forward to seeing it. You know, one of the things that we joked about and talking about the historical observations on presidential cycle and the 4-year cycle and stuff like this. But there was some old studies, I think we tweeted one the other day, that historically the incumbent party traditionally, I think it's like a 3-month lead up to the election on our stocks up or down, has like an 80-something% success rate on predicting, does the incumbent party stay in power if the market's up? And if it's down, it usually flops. But this year was a little bit of an oddity because of obviously the incumbent party is not the president is not running. But right now, the betting markets say it's going to be about a coin flip. So there's going to be, like you mentioned, both sides.
There's going to be some very, very unhappy people on November 8th.
I wonder if the small cap, you get a little bit of the sort of end of year seasonality, which historically small caps, kind of that November, December, January period tend to get a little bit of a boost historically. I wonder if there's a little element of that too, but it'll be fun to watch. I'm ready for some small cap value outperformance, Rob. And not to mention, I don't even think we mentioned emerging markets today, or gold, which is at all-time highs right now.
Well, you did mention emerging markets in passing as a possible path for another Nixed strategy. And rest assured that Nixed International and Nixed Emerging Markets is on our radar screen as something that could be fun.
Rob, this has been a whirlwind as always. It's been super fun. Listeners, if they want to check out the Nixed ETF, you guys got a website? What's the best place to go? Is it at Alpha Architects? We'll add it to the show notes.
Alpha Architects or Research Affiliates website, researchaffiliates.com, alphaarchitects.com. Both would have links taking you to detailed information about the Nixed Index and the Nixed ETF. RAFI Indexes also has a website, and the RAFI Indices website will have detailed information about the Nixed Index. One nuance I didn't mention is we do have quality filters set at very low quality threshold, so that if a company is dropped from the index and looks highly likely to be a value trap, we leave it out. But it's only a very small fraction of the deletions that are troubled enough that we say, let's not do that one.
Trying to avoid the falling knives that go the way of the dodo bird. I like it. Rob, it has been a blessing. Thanks so much for joining us today.
Thanks for the invitation. These conversations are always fun. Part of the reason is they're long enough conversation to get into some really interesting stuff.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.